Inizierei subito con la prima relazione che ci viene proposta dal dottor Curran, che ci parlerà del loan market nel contesto europeo, un asset class che negli ultimi anni anche nel vecchio continente sta aumentando il proprio peso specifico, e oggi il dottor Curran ci illustrerà per quale motivo può essere un'interessante scelta di investimento in mercati ad alta volatilità. So I give the floor to Mr. Curran for his speech, please.
So this morning, what I wanted to do was talk a little bit about the European loan market and why we think it offers an attractive opportunity against the current market backdrop. To set the scene, before I get into the slides, I think as an investment team, two of the key themes that we're focused on as we look forward to the year ahead is, first of all, it's persistent inflation and the need for higher interest rates to help combat that. And then the second part, which is a follow-on from the higher inflation, is the expectation that we're going to have an environment with weaker growth in 2023. Against this backdrop, I do think we believe the European loan market offers an opportunity for investors, first of all, to gain access to high income, but you do that with very low duration exposure. And then you're getting access to a market that historically has proven to be less volatile than other fixed income markets. If you could move to slide 4, please. So what I want to do is start on why the European loan markets is attractive against the current market backdrop. And the first point I would make is that European loans tend to be senior secured. About 99% of the market are senior secured. What that means is that you sit at the top of the capital structure, and this means you have the first claim over all of the assets within the company. This makes a big difference when you get into a default scenario. Recoveries tend to be around 60 to 70% in the European loan market. If you compare that to other fixed income markets, take the high yield market, for example, which on this slide you can see would be the bonds at the bottom of the left-hand side, or the junior bonds in the middle, I should say, the chart on the left-hand side. The recoveries in that market tend to be about 30 to 40% over time. On the next slide, slide 5, the point here is that the European loan market offers protection against rising interest rates. The idea that inflation is transitory, I think, has long passed. We'll move past that. Somebody just mentioned that they cannot see the slides. I can't see the slides either, but I'm just going to keep going. Hopefully you can fix that. Inflation is persistent, and central banks will need to continue to raise rates in order and keep them at elevated levels in order to bring inflation under control. In these types of scenarios, the loan market as an asset class tends to do quite well. On the slides, and we can share them afterwards, but we show a number of scenarios where in periods where interest rates were rising and high, the European loan market and the loan market in general does quite well. So for example, in 2022, interest rates have risen about 200 basis points. The European loan market through the end of October was down about 6%. But if you compare that to through the end of September was down about 6%. If you compare that to the fixed rate market, so high yield and investment grade, they were down about 15, 16%. That's almost entirely driven by the duration impact. The last point I would make just on this is defensive sector positioning. The sector profile of the market is very defensive. The largest four sectors in the loan market tend to be the most defensive. They don't have exposure to higher input costs the way some like chemicals and other energy input sectors have seen this year. End demand from customers tends to be a lot stickier. So these four sectors are healthcare, telecommunications, business services, and then software. Combined, they make up about 55% of the overall market. And importantly, the European loan market tends not to have any exposure to some of the more cyclical or tail risk sectors as we see. So sectors like energy, which has driven volatility through markets over time, consumer exposure. As we look forward, we don't have a lot of that either. So these are the factors that really drive the stability of the loan market. And in turn, I want to talk just very briefly about the current opportunity. So we believe the European loan market offers an attractive yield against the current market backdrop. The first point I would make really is just the current yield on offer against the historical volatility. We have a nice slide that shows this this graphic, but I don't think it's being shown here. If it is, it's on slide 8. What we can say is that currently the European loan market offers a yield of over 10%. And over time, it's offered much lower volatility than a lot of other fixed income asset classes like emerging markets, like high yield. It tends to be a lot lower volatility. And I would say that a yield of 10% is quite unusual for European loans. So to get access to that at this point is very attractive. We do show a graphic where we're showing the premium you're getting in the European loan market relative to other markets on a credit spread basis at the current time. So to give you an example, compared to the US loan markets, you're currently getting about 110 basis points additional credit spread versus the European high yield market, it's about 170 basis points, and versus the US market is around 300 basis points. Big premiums on offer for a market. We don't think that's warranted based on the underlying fundamentals. One of the key things investors are concerned about is defaults on a backward-looking basis. Again, if anybody can see the slides, it's on slide 9. But on a backward-looking basis, defaults are about 0.5%. That is quite low. Now, as we look forward to next year and the expectation of weaker growth, we do expect defaults to rise, but we think they rise to a level of about 3 to 4%. That's broadly in line with where ratings agencies are expecting to get. That is in line with long-term averages, and in our view is quite manageable. And as I mentioned, if you look at that yield on offer of more than 10%, and the fact that historically losses in the event of default in our market tend to be only about 30% or so, investors are being well compensated for potentially higher defaults. And in fact, at current credit spreads, as I mentioned earlier, of over 700 basis points, the market is actually implying a default rate of about 10% every year for the next 3 years. And even if you look back to the great financial crisis, 2008, 2009, defaults only very briefly peaked at 10%, didn't persist at that level the way markets are pricing in right now. So again, we're being well compensated for default risk. And then the key reasons why we don't think default risk, I'll finish up on this, but the key reasons we don't think default rates spike materially higher, it's on slide 10 if you can see it, but there's 2 key drivers. First is the scale of equity that's been contributed to new deals coming through our market over the last 10 years. The owners or the equity sponsors in these deals have been putting in about 45 to 50% equity whenever they bring a new deal to the market. If you compare that to the lead up to the financial crisis in 2008, 2009, this was about 25, 30%. So a much bigger equity cushion put in there. What that means is there's a lot more value that needs to be eroded before our debt becomes impaired. It also means that equity holders or equity sponsors will be more willing to support businesses through a difficult period. And I think we saw this in action in 2020 and through COVID, as private equity sponsors put new capital into businesses to help them through a sticky period. The second point was just on the interest cover ratio. This measures to the extent you don't know what it is, it measures the extent to which earnings of a company will cover its interest costs. Coming into this year, that was about 4.5 times for the European loan market. This is slightly decreased this year, given we've already had an increase in base rates. However, given the fact that we're already at 1.5% base rates, excuse me, and we expect interest rates to top out at about 2.5% over the next year or so, we believe the companies in the European loan market have plenty of cushion to weather higher interest rates. So on that basis, we don't see a lot of unsustainable capital structure. I'm not sure how I'm doing on time, but maybe I'll just leave it there. Maybe what I will say just to finish off is, I think as you look forward, and we're offering a very attractive opportunity for the loan market, but what you do want from your loan manager is to focus on the downside protection, to deliver what you want from a European loan, what you want from the European loan market. And that is attractive income being delivered in a stable manner with a very strong focus on risk-adjusted returns. And with that, I'll leave it there. Thank you.
Thanks, Mr. Curran. Adesso tornerei dal dottor Lombardini, se ci sente, così da potergli concedere di chiudere il suo intervento, visto che prima è stata la connessione.
Sì, grazie. Mi spiace, non mi è mai successo, ma la legge di Murphy ha colpito. Comunque avevo più o meno concluso. Avevo parlato delle prospettive di rimanere al caldo, al freddo in inverno, avevo ricordato che i prezzi dell'energia erano già alti alla fine 2021, sono state fatte delle misure congiunturali, questo helicopter money, per dirlo all'americana, che il governo ha distribuito, ma sono necessarie delle misure strutturali. Allora penso, per un money manager che vuole vedere, io non voglio sbilanciarmi su previsioni di prezzi, ma secondo me non ci si può aspettare che i prezzi scendano magicamente. Abbiamo un orizzonte di prezzi alti per i prossimi mesi o anni, e ho anche dato un paio di ricette di misure strutturali che bisognerebbe fare, cioè il rilancio della produzione nazionale di gas e una spinta seria alle rinnovabili, dove quello che manca non sono i soldi, ma sono le autorizzazioni. Ecco, io concluderei qua, però vorrei ringraziare il professor Brambilla per avermi invitato e tutti voi per la vostra gentile attenzione. Grazie.